Something is not lining up in the silver market right now, and if you're expecting a calm, predictable open tomorrow, you may be in for a serious surprise. The positioning, the volume shifts, the options flow, and the geopolitical backdrop are all flashing signals that the next session could open at a level very different from what most traders are pricing in. This is not noise. This is structural tension building beneath the surface, and when silver moves under these conditions, it tends to move fast and without mercy. Over the past several sessions, we've seen aggressive short positioning reappear near key psychological levels. At the same time, physical demand premiums remain elevated in multiple regions, especially in Asia, where wholesale spreads have not normalized despite paper price pullbacks. That divergence between paper futures and physical demand is at pressure point. Historically, when that gap widens and inventory drawdowns accelerate, the opening print after a low liquidity window can gap sharply in either direction. Let's talk about COMEX positioning. Open interest has expanded, while registered inventories remain relatively tight compared to historical stress periods. When you have high paper leverage resting on comparatively thinner physical backing, it creates vulnerability. If even a modest percentage of contract holders stand for delivery, or if margin requirements shift unexpectedly, forced liquidations or rapid covering can occur. That's where gap risk is born. Not from headlines, but from imbalances. Now layer in macro. The dollar has been volatile, bond yields are unstable, and inflation expectations are refusing to fully cool. Central banks globally are walking a tightrope between tightening credibility and recession risk. Any overnight headline, whether it's related to trade policy, sanctions, geopolitical escalation, or unexpected economic data, can trigger algorithmic repricing in metals before retail traders even wake up. When Asia opens, liquidity is thinner than during US peak hours. Thin liquidity plus heavy positioning equals exaggerated moves. Here's what concerns me most: volatility compression. When silver trades in a narrowing range while derivatives exposure builds, it's often the calm before expansion. Markets do not stay compressed forever. They resolve. And when they resolve near a major inflection level, the open can gap above resistance or below support without offering you a comfortable entry. If you're assuming tomorrow will open near today's close, you're assuming stability in an environment that is anything but stable. We're also seeing unusual options activity around short-dated expirations. That tells us larger players are hedging event risk. They are not relaxed. They are preparing. And when institutions hedge aggressively into the close, it often signals that something is expected during the off-hours window. Whether that's data, policy language, geopolitical developments, or simply positioning stress, it creates asymmetric risk into the next session. Let's consider the bullish scenario first. If silver opens significantly higher, it could be driven by short covering combined with renewed physical bids. A break above a key resistance zone during thin liquidity can force momentum algorithms to flip long, accelerating upside. Once those levels are reclaimed, technical traders re-enter, and suddenly, a move that began as a gap becomes a trend day. In that case, anyone waiting for a minor dip may never get it. Now, the bearish case. If silver opens lower, especially below a widely watched support band, stops will trigger. Retail traders often cluster stop-loss orders just beneath obvious technical floors. Smart money knows that. A swift move below support during illiquid hours can trigger cascading liquidations, pushing price further than fundamentals alone would justify. Then, once weak hands are flushed out, accumulation quietly resumes. That's how traps are set. The key point is this: expectation is the enemy. When the majority of participants believe they understand where price should open, that's when surprise becomes most powerful. Markets exploit consensus. Right now, consensus appears overly confident in a stable open, yet the data does not support that comfort. We also cannot ignore geopolitical undercurrents. Trade tensions, sanctions rhetoric, and supply chain vulnerabilities in major silver-producing regions remain unresolved. Mining disruptions, export restrictions, or currency instability in producer nations can impact sentiment instantly. Even rumors can move futures markets when leverage is elevated. And with algorithmic systems parsing headlines in milliseconds, price reacts before human traders can process the information. Another factor to watch is correlation breakdown. Recently, silver has shown moments of decoupling from gold and from equity indices. When traditional correlations weaken, it often signals that positioning in that specific market is driving price more than macro flows. That makes opens more unpredictable because cross-market hedging becomes less reliable. If you are a long-term holder, this is a reminder not to anchor your strategy to a single opening print. If you are a short-term trader, this is a warning to respect gap risk. Do not assume you can react after the open at comfortable levels. Plan scenarios in advance. Define your risk before the market defines it for you. This is exactly why Silver War Room exists. We monitor positioning, inventory, macro catalysts, and geopolitical signals so you don't have to rely on guesswork. We break down what smart money is likely preparing for and what that means for your exposure. Whether silver gaps up or gaps down, the goal is not panic. The goal is preparation. So tonight, do not assume tomorrow will look like today. Review your levels, understand where liquidity is thin, know where stops are likely clustered, and be mentally prepared for volatility expansion. Silver does not ring a bell before it moves. It shifts, it gaps, and it punishes complacency. If you value staying one step ahead of these shifts, subscribe now and hit the bell icon so you don't miss critical market updates. We deliver data-driven alerts designed to help you stay informed, stay ahead, and protect your capital in uncertain conditions. Tomorrow's open could redefine short-term momentum, and when it happens, you'll want context, not confusion. Stay sharp, stay disciplined. And remember, in markets like this, preparation beats prediction every time.